right, good afternoon, folks. This is Fairsley with Trade with Text. Today we're going to be talking about a pretty interesting occurrence in the stock market this week, the GameStop short squeeze, which might sound like gibberish to you, right? But I'm going to try to explain it as best as I can, okay? So we were going to have this in a webinar on Tuesday for our members in the Trade with Text chat. Might still do that, but I want to make sure I get this information out there earlier rather than later because we still got a couple of trading days with GameStop before things cool off, okay? Now, first things first, if you aren't subscribed to the channel, make sure to subscribe. This video is public. You can share it with anybody, right? Again, it's not a private members only webinar, but we're going to jump into the information here, okay? So first things first, this is what happened. If you missed it, if you're living under a rock, GameStop soared prior to this week, right? It had jumped up from $20 into the low 40s, and then this week made an insane move all the way to new all-time highs and spiking up to the 76s. That's right, 76s. So on Friday alone, it gained over 50% on incredibly high volume, okay? Very popular stock last couple of weeks because of that, and for a couple of other reasons I'll mention in a second. And in the span of, a couple of hours, if we zoom it into the intraday chart, you can see it skyrocketed from the 50s to the 75, 76 area. Okay, we're going to talk specifically about Friday's move, but in order to understand the concept of a short squeeze and what we're going to call for now a gamma squeeze, you have to understand why this stock was moving up so aggressively to begin with. Okay, so the hype all started when it was being labeled as a turnaround play, right? Which is pretty common, especially with the way that COVID has impacted all these stocks, right? All these negative effects. We're seeing a lot of these companies that have closed down shops, they've tried to really stay in business, start to turn things around. So it's not really a hot take that GameStop was a turnaround stock. That was a pretty popular opinion. But what really started to increase the hype, okay, was Ryan Cohen making a big investment and basically becoming an activist investor, right? That's what they're called. Activist investors see an opportunity where management is really squandering the process and they're just missing out on a bunch of different market share opportunities. And they come in and they say, hey, you know what? I want to say in what the company does. I will continue to buy a lot of shares if that's the case. And you have to give me a seat on the board. Okay. Now, to give you an idea, Ryan Cohen is the founder and CEO of Chewy, right? Which has also made a pretty big run up in the past few months. That's a stock that we wrote up to the hundreds as well. In the chat room, we were trading this day in and day out, but he started Chewy, which took off, became a big company, and captured a ton of market share. So he knows his stuff. That's the bottom line. And that's when investors started to notice. Okay. Now, the kicker here, the reason why GameStop got so much momentum in the first place is the short interest. And we do have another YouTube video on this where we talk about short squeezes alone. GameStop was kind of a weird occurrence because for the longest time, it's had this extremely high short interest, right? And we can actually go to the next part here too. Because normally, the short interest basically tells you how much of the float is short, right? So out of all the shares that are being traded publicly, how many of those are bears, people that are shorting actively against the stock, right? So the normal short interest for a standard stock is like 5-10%. Okay, 5-10%, that's the norm. Anything above 20 is typically high short interest. Now, just to be clear, you can find this information on FinViz. I might make another YouTube video showing you guys how to find high short interest stocks on FinViz. Yahoo Finance, Seeking Alpha, they all have the short interest, okay? They're not updated as regularly as some of the paid platforms, but they all have it, okay? So GameStop, the short interest was over 100%, and even before it ran up, it was up in the 90s, okay? Which is huge. I cannot explain to you how rare that is, okay? Now, here's the kicker. You might be thinking, if all of these people are short, they must be onto something, right? The problem is when a bunch of investors crowd one side of the trade, short or long, doesn't matter which side, and there is even the slightest increase in buying pressure or selling pressure, it has the potential to trap them. So a short squeeze is a fancier way of saying a short trap, right? Because basically, let's put this into simpler terms where you don't need to understand short selling. if I bought a stock, right, if I'm long GME, and me and everybody I know, every investor I know has bought GME, and for some reason, it could be a headline, could be negative comments from the media or whatever, the stock starts selling off, right? And we had all bought at 10 bucks, and the stock was climbing, and then it starts dumping under 10. Okay, what this is going to trigger is a lot of sell pressure, because everybody being too crowded on one side of the trade creates a trap, right? They have to keep selling, and then even if there's a pop, they usually sell into that pop and it drags it even lower. So this stock, if it just cracks 10 bucks and it's too crowded, could result in a big drop. It's the same concept for a short squeeze, but inverse, right? Where if everybody's shorting a stock as it starts to run up, okay, pulls back and it starts to run up again, that ounce of strength could be enough to make shorts start to cover, and it creates kind of a parabolic move. So we typically see this with more volatile stocks, right? Stocks with a lower float, right? Meaning that they trade a lot thinner. To keep this simple, because GameStop was so popular, because the stock started to gain a lot of hype, that was the first part of the equation, right, that we had talked about. That in combination with the high short interest created a unique opportunity where the stock was very high risk, very high reward, but if there was even an ounce of unusual buying pressure, it would shoot up. So that's what we saw pretty much every move leading up to this week. And it was a combination of that short interest with one other thing resulting in the pop-up on Friday. Okay, that major run. Because again, no news. There was no catalyst here. It's just a combination of hype, high short interest. So again, 20% is usually high short interest. We had over 100% at the time of the second run. Okay? And then something that we call a gamma squeeze, which is incredibly rare. I think the last time there was a real gamma squeeze was in 2008. I think it was the Volkswagen run-up, right? Correct me if I'm wrong. But it's a unique occurrence, and you do need to understand these first two parts to see why this played a role in it. This isn't something that you need to learn as a strategy. It just explains the move, right? The rationality behind it, because it looks so irrational at a glance, but you need to understand share structure. Now, to get into the gamma squeeze part of it, and again, remember for the short interest, right, and the short squeeze, the reason we saw such an aggressive climb is because bears are underwater and they are forced to cover. So it's just stop losses triggering and triggering until the stock eventually loses steam. Okay? Now, the gamma squeeze comes into it, and this is where it gets really complicated. So I'm going to do my best to simplify. But basically, when we have a bunch of traders buying out of the money call options, right? So out of the money call options, meaning that, if GameStop is trading at 50 bucks right here, okay, and I think it's going to 60 bucks by the end of the day, which is insane because it's a Friday. That would be the expiration, right? If I start buying out of the money call options, okay, my strike price is at 60. So when the price of the actual stock goes above 60, that goes in the money. Okay, so out of the money for calls specifically is when the strike is over the share price. Okay, price per share. And then in the money is when the strike is below for calls. Okay, so as that share price rose, those calls became in the money. So what happened is a lot of traders, because, smaller investors can't really afford to load up a $60 stock, and they're not going to make that big of a difference in the price action if they do, typically, right? They started buying out of the money calls like crazy. Now, the weird concept here is that every options trade has two sides of it, right? We have standard investors that typically buy the out of the money calls, out of the money puts, et cetera, right? So let's just call them retail. Obviously, I know institutional investors do that too, but they typically throw on spreads. Now, the other part of it is market makers. These are basically people that create liquidity in the markets, right? There has to be another side to every trade. They will run the math real quick and say, you know what, I'm willing to write as many contracts as needed for this strike price, right? And just for standard stocks, if we're not talking options, the simpler way to see it is that when I'm selling a stock, it doesn't necessarily have to be another retail investor on the other side. It could just be a market maker creating liquidity, and that's normally the case. Okay, somebody's got to keep the markets liquid. If not, there's nobody to buy and sell, right? There's no incentive. So with these stock options, what happens is that these market makers, they write a contract, right? And they say that basically, since you're buying the out of the money call options, right? If the price of that stock exceeds the strike, if it goes in the money, okay, so if it goes out of the money to in the money, these market makers, since they wrote the contract, it is a financial obligation. They have to cover 100 shares per contract, right? Because we know that one options contract is 100 shares. They have to cover themselves, right? And actually buy that stock back. So what happened, right, is if we're just looking at this from a very simple standpoint, is if enough retail investors are buying out of the money calls and those calls go in the money, market makers now have to buy 100 share lots repeatedly, right? As the stock is already going up. Okay. So just to kind of tear this down again, a lot of people bought out of the money calls. These market makers, because the stock price then went up further, got trapped and they had to stick to their obligation and buy common stock. Okay. So what this created was this, and it was mainly during the afternoon move, right? It was mainly during the late morning, early afternoon move where we saw that big meteoric rise in volume, right? So kind of starting around 12:10-ish. That's where market makers really got screwed. That's where short sellers got screwed. And the stock skyrocketed. It went from $50 to $75. Now, you might be asking yourself, well, how do I measure this? How do I gauge it? It's really tough to look at the out of the money call option volume and say this is going to be a gamma squeeze. It's such a rare occurrence that you shouldn't be using that as a strategy, okay? But the short squeeze is a much more common strategy. We use it in our chat room all the time for day trades and swing trades, okay? And that actually gives you something tangible, right? You can see the high short interest and you can act on it, versus you can't really see that call option volume that regularly, right? And that easily. So it's much tougher to trade, right? So if you missed this specific move on GME, I wouldn't kick yourself too much. If you capitalized on it, great, right? Congratulations, that is awesome, okay? But that's where the gamma squeeze came into play, because again, market makers were forced to cover, and that resulted in a lot of buying pressure as people kept buying and buying out of the money stocks, or out of the money options, and the stock went past that strike price, okay? Most of it was in the 60 calls, and the stock went above that at like 12.20, okay? Very aggressive move. All right, now the question is, and again, if you have questions on that specifically, be sure to ask. The question is, what happens now, right? What are the major takeaways and what happens now? Because to kind of put this simply, the settlement date is usually 2 days after the date of the trade, right? So if these market makers are being forced to stick to their obligation and those calls have now gone in the money, that means that T+2, basically, right, on Tuesday, since we were on a Friday, will be the settlement, okay? So basically moving forward, that's the biggest takeaway, is that GameStop still has this high short interest, right? And the settlement is on Tuesday. So there are 2 possible days of more unusual momentum for GameStop, okay? There are 2 possible days. In my opinion, if I'm gonna be completely honest with you guys, I think that best case scenario, there's a Monday morning pop and then a fade. The only way that would go the other direction is if this somehow gets more demand and more hype than it did on Friday, which is very unlikely. So I'm not trying to make a bear case for this or crap on the stock or anything like that. Just from a rationale standpoint, right? there has to be higher hype and higher demand than there was on Friday, and that means GameStop is going to have to top a 50% move in a short period of time. Okay, so what this really boils down to moving forward, right, is the settlement on Tuesday. That's the cutoff date. Okay, and then also whether or not this demand is sustainable, whether it can increase more. Now, there are two basic rules that I always use in the chat room, and again, this is a paid chat, but we do have a free week. If you guys want to try a sign up, we're going to be discussing GME all week, so you can even try it for free week and then ditch it if you don't like it. But the two rules that we talk about a lot, usually on hype plays, they have 1 to 2 days, right? It's day 1, day 2, and then day 3 they crap out. So in terms of demand, in terms of hype, we might see some follow through on day 2, right? Because if we look at that GME chart, Friday was day 1, and the way that we're defining day 1 or day 2 is just another breakout. Okay, so this was a day 1 back in the day. This is a day 1 move again. Okay, and you can see what happened after that other day 1. I know it's a different scenario, but it popped up a little bit more and then it faded. Okay, it didn't completely reverse, but that's when we stopped playing it as consistently. Okay, so what I see as the potential scenario playing out here is that day 1, maybe a day 2, and then a fade. The other part of it, because it's really hard, this is Trader Psych 101, it's really hard for traders to stay interested about something in more than 2 days, right? Normally people lose interest, they say, I made my money, I'm done, I'll move on to the next thing. Okay. The other part about this is that price changes sentiment, which is a really funny way of looking at things, but experienced investors know what I'm talking about. If the NASDAQ is dropping like a rock because of the COVID crash, and everybody is super scared and they don't want to buy, as soon as there's a little upturn, right, sentiment is going to start to shift because price started moving first. It doesn't work the other way around, right? Most people think that sentiment changes price, and while that was the occurrence that happened with GameStop this past week, it's unusual. It's irrational to think that that's always going to happen, right? So price, if it were to downturn even slightly, is going to do a big amount of damage on hype, right? On demand. So if GameStop having ran up to $75, dipped down to 65, if it drops all the way down to 50, all the people who bought here and here and here are going to start doubting it. They're going to start losing hope. They're going to say, well, you know what? I might just sit on the sidelines, which you might see as a good thing because short interest is still high. But the bottom line is that demand is not higher than it was on Friday. So that's what needs to happen. If you're watching it on Monday, GameStop needs to be explosive all day in order to sustain this move. Okay? Whether or not you think that's likely, that's going to decide what you do moving forward. Now, the only other thing I'll say for this stock, it's a hell of a lot of fun to trade. It's very volatile. I'll be, the kind mom looking out for you here, right? Not dad. We go over this in the chat room all the time. I'm the mom in the chat, okay? I'll be the kind mom to say it. Use a smaller size, please, for the love of God. If you're thinking, well, I can just buy some out-of-the-money puts or out-of-the-money calls and have some fun, yeah, that might be fun, but use a smaller size, okay? The price swings will be there. We just got to be able to manage risk on them, okay? So bottom line, don't short high-interest stocks, right? You want to just play those on strength, okay? And the other part of it is that we had a very unique situation here called a gamma squeeze where market makers were forced to cover, and that created a much higher momentum opportunity in the afternoon, okay? So awesome move. I know this was a popular stock on Reddit, right, on Wall Street Bets, and that's kind of what got it, all that momentum from the traders that call themselves retards and autists, but it was a fun stock to trade. It still is. Hopefully we get 1 to 2 more days out of it before it exhausts and turns back down. Okay. If you traded GameStop, congratulations on your gains. Don't rationalize everything else with that. Overall, good luck. Okay, good luck moving forward, and I hope you guys learned something from the video. Okay. Thanks so much for watching, guys. Have a great weekend.